Yo, what's going on, everyone? Welcome back to another video. I hope you guys are all having an amazing day, week, morning, night, wherever you may be. In today's video, we're going to talk about sniper entries and how we can actually implement supply, demand, market structure, liquidity, imbalance, and all these other concepts that I make videos on and other people make videos on, and add them all together to actually incorporate it into getting and executing a sniper entry. So with that being said, without further ado, let's get straight into it. Now, something that we have to go over is that there's two types of learning. There's passively learning, where you're learning along the way, and then there's static learning, like as in you learn one day and then you don't learn the other, and you learn the third day and you don't learn the fourth. And then on top of that, you're not actually implementing or back testing or putting your skill to the test after you learn something, right? Because at the end of the day, the best way to learn something is to put your skill to the test after you learn it. It's to test yourself, essentially. That's why standardized testing sometimes is good. Not all the time, not the ones in school, but it could be good. It could be useful, right? Because you're testing your knowledge to see whether it actually works or not. And then once you come to the conclusion that yes, it works, then you can execute and you can move on to the live markets. But if you come to the conclusion that it's not the best, it's not effective, then you can focus on the weaknesses and turn them into the strengths. So remember, even your weaknesses have something important to tell you. And something I like doing a lot is after I learn something, or like after I would learn something, I used to go on the charts. Actually, no, I won't tell you that. I'll tell you guys a better one. So I used to be involved in a lot of Telegram communities. Back in the day, of course, not now. I deleted my Telegram if anyone's wondering. But yeah, back in the day, I used to be involved in a lot of Telegram communities, and I had no idea about smart money. So when I would see a chart, something like this, right? Like a demand zone, I was thinking, like, what's the significance behind one candle? Like, I'm so used to buying at a level of support here. Why are people buying over here? And I was genuinely confused. I thought there was some weird mathematical basis justification for why people were buying here, and my head was exploding. So what I would do is, after I would ask questions and I'd watch some videos and enlighten myself about the topic, I'd go onto the Telegram the Telegram chats and the Discord groups that, well, I wasn't on Discord, but in today's days, a lot of people just use Discord. I would go on the communities and I just surf through the charts and see how other people are marking up their charts. And after that, I started to see what they started to see. So basically, it's if you stay around with a friend, if you stay around with 10 people who know what they're doing for a long enough time, you'll basically become the 11th person who also knows what he's doing. And you could use that advice for life as well. Just be careful. But so then how can we use imbalance, concepts like supply and demand, market structure, all in one to actually make money into these markets, more specifically catch sniper entries? Well, there's two things that we must go over. One, do you really want to catch a sniper entry? Because although sniper entries look very, very enticing and extremely enticing. They look very nice and enticing because look, like, this trader over here, he entered right here and he had zero stop loss or zero drawdown in the market, his take profit. You also have to take into account the fact that a lot of traders miss trades due to the sniper entries, because what a sniper entry is, it's basically you pinpointing and calling the exact point where the market is going to reverse, and that's when you execute your trade. And a lot of traders actually either get stopped out to one of these three. One, due to spread, because they don't know how to account for spread, or they forget. That's spread. Number two, they missed the trade by a couple of pips, meaning that the market, let's say I'm looking to buy at this point, or I'm looking to sell at this point. As you can see, the market reaches just 6 pips and a half shy, and then the market sells off, hitting take profit without you. And that could also cause a lot of problems in the long run. So remember, it's all about what your trading style is and whether or not catching sniper entries is really for you. But this video hopefully will provide you with the information that you need so that you could catch sniper entries without actually missing out on the trade, although this won't work all the time. But with sniper entries without missing out on the trade, and overall just having a very nice entry that's going to prioritize valuable time and, of course, a good risk management plan to it. So without further ado, let's get straight into this video. Number one, it's all about structure. If you don't have a good idea or understanding of structure, then you won't know when to sell or when to buy. It's simple as that. As in, the market could be trending upwards, but let's say I see a break of structure like this. If I don't understand breaks of structures and trend reversals, then I'll be so stuck to the bias of buy side that I'll actually be blinded to the fact that the market is now trending down, and later on in the future, that's going to cause a lot of unnecessary losses. So what you need to first confirm is that you have trend direction up and check. If you don't have that box ticked, then then you shouldn't be watching this video, to be completely honest. Watch some of my other videos. They're a lot more helpful. Remember, go over the basics and then work your way to the top. Like, imagine you're a beginner of forex, right? You're on level 1 of the building, and the building hasn't even been made yet. It's only one story, but you're trying to get to 19. So you have to work your way to the top strategically, and of course, when you get to the top, after you put in that work and you understand it, it'll be so much more worth it because you have a good understanding of what's going on. So in this case, the example that I bring towards you is this example of a uptrend on Euro USD. So we can see that on the 45-minute time frame, the overall trend does seem to be going up, right? If I actually go to the 4-hour time frame, sorry. If we go to the 4-hour time frame, I believe it was here. Yes. The overall trend is moving towards the upside. As you can see, we have a low, and then there's a high, and then there's a higher low, and then there's a higher high. You know the very, very basics of what's going on. But understanding trend is not just enough, because that's a very vague term to say that the market is trending in a higher high, higher low trend, so therefore I'm going to buy. Because if that was the understanding, right, then why would you not buy right over here? Or why would you not buy over here? We basically need to have sufficient reasons and premises to actually execute an order. And knowing that the market is creating higher highs and higher lows is not enough. Matter of fact, we can see that on the 1-hour time frame, after the market had reached this high, there was some type of sell side pressure which was executed. Sorry, not executed, wrong terminology. But there was basically a lot of orders to the sell side that were favored, that the market favored, and then that caused the market to go downwards. So you might be wondering, how could I have actually taken advantage of that? Well, there's multiple ways. The first of that is seeing the internal structure within the external structure. Within the external structure, we can see internally that there's this low, and then there's a high, there's a higher low, and then there's a higher high. As soon as we see that there is this break of structure within this external trend, internally there's a break of structure, what we're now going to do is we're going to make our way to the smaller time frames to get an overall idea of where the momentum started. Remember what I just said. We're going to have to go to the smaller time frame to get an overall idea of where the momentum started. Now, what do I mean by the momentum started? Well, if the market produced a break of structure at this very point right over here. By the way, this might not be the best example, but it is an example, and I'll go over why this might not be the best example later on. But let's continue off with this. As soon as we see that there's a break of structure, we understand one of two things. Number one is that we were following a pattern that we're not following anymore. Number two, the only possible reason to why that pattern is not being followed is because the momentum is shifting to the opposite participant of the market. That means that this was the pattern. The market was creating higher highs, higher lows, and eventually we sold off because there's more orders preferred to the sellers, or there's more sell orders than buy orders, and that caused the market to cause a reversal. So in that case, what do? What we want to do is we want to go back to the origin of the move. The origin of the move, meaning that where the move actually started, where buyers lost control and where sellers took over. Remember, this game, you're not here to prefer one side over the other. You're here to trade what you see and what's present. That's literally it. So if the market is going up, you buy, and if the market is going down, you sell, because that's the difference between a trader and an investor. An investor, he's looking to buy long term. Of course, they don't want to see the market fall and make these dips and corrections and pullback phases and liquidity grabs and etc. But as a trader, we don't care. We're here to trade whatever we see and whatever is there. If the market is going down, I'll sell. If the market's going up, I'll buy. So how do we pinpoint the entry? The first thing that now we must do is find the key point of interest. So find your key point of interest, because the key point of interest is where the market is going to reach, it's going to return back to. And as soon as the market returns back to that point of interest, that's when the market will provide lower time frame confirmation, lower time frame premises, lower time frame Wyckoff and liquidity grabs, and that's where you could actually look for those very clean smaller time frame entries. So I'm talking a lot. Let me go back to the example. In this case, let's go to the 5-minute time frame, and we can see that we have this order block right here. This area of supply. So my key point of interest is right over here. And essentially what I'm assuming is that the market will now return back to this key point. And as it returns back to this key point, we're going to see a continuation. A continuation meaning a continuation of this move down. Something interesting that I want to talk to you guys about is actually the fact that why didn't the market use this supply zone over here? And shout out to Pips of Persia. You guys should check out his videos. He makes very nice videos. If I were you, I'd check him out. I'd subscribe to his channel. He's a very cool guy. I love the way he explained things, and he said something very interesting. What he said was that the market makers, or the big people, the smart money essentially, the reason they did not use this supply zone or this demand zone, in this case we're going to use a supply zone, is simply because this supply zone did not suffice the amount of orders that the market makers were trying to execute. And rather they found a better supply zone that could have actually, that basically was sufficient enough to execute those orders. So basically when the market reached that point, that's where you would have wanted to actually execute the trade. And something that I came to the conclusion was of that we become way too addicted to our analysis. And that means that if there's two order blocks, one over here and one over here, we box ourselves into two decisions. Either one, it's going to be this one, or it's going to be this one, but it can't be both. Obviously it can't be both, but we basically only choose one. And I believe that's the wrong mentality to have, because remember, at the end of the day, with the limited resources and tools that we have, there's no way to actually confirm whether or not this supply is going to hold or this supply is going to hold. Because I think I can bring at least 16 different examples of when the market used a supply zone which no one was expecting at all. Literally no one was expecting, but the market still used it. And not only did it use it, but it used it to provide those huge move downs with those amazing RRs that everyone's crazy over getting. But yeah, with that being said, let's continue on with this example. We could see that now that the market has entered this area of supply, we're simply going to go down to the smaller time frame to see what the smaller time frame is going to do, and it's a repeat. Remember, we're in a cycle now. So what was step number one? Step number one was simple. What is the pattern? As in, the market structure was bullish, we're following a higher high, higher low pattern, and then the market broke down with strong momentum and the pattern was invalidated. We're literally going to do the exact same thing. Oh, looks like I can't go to the 1 minute time frame, but mind that. But yeah, we're literally gonna do the exact same thing. The only difference is what? The only difference is that we're doing it on the smaller time frame now, and that's it. So people get confused. Now this is where a couple of questions are raised, such as, when should I be using the smaller time frames? When should I be using the higher time frames? When should I be using this? When should I be using that? It's very simple. If the market is not in your point of interest, because something that a lot of people would do is before price even reaches their point of interest, they start looking for buys and sells. It's important you keep your mind boxed and only aimed at this supply zone, meaning that as soon as the market reaches my key point of interest, that's when I'm going to look for executions. That's when I'm going to look for orders. That's when I'm going to look for confirmation. But if literally everything is for confirmation, meaning that, oh, if the market breaks structure here, I'll buy. If the market breaks structure here, I'll sell. Then essentially you're trying to catch every single move. That means you're literally trying to catch every single candle, right? So if the market goes down here, you're like, oh, I have to sell, I have to sell. Oh no, I have to buy, I have to buy, I have to buy, I have to buy. And then what's going to happen is you blow your account, and then you cry, and then you want to quit forex. And it's not productive whatsoever. So what do we do here? As soon as the market is in our point of interest, all we want to do is see a type of break of structure or some type of weakness. Now, remember, this weakness is not just a break of structure. A BOS is one of many confirmations. But what we want to see is we also want to see momentum in volume. As in, a lot of the times, if I can find an example, I would love to show you right now. No, that's not a good example. Right here. Some issues are very, 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 very insignificant, right? As in, someone might be looking to sell at this point simply because there's a supply zone here. Now, number one, and let's assume like also there's some type of break of structure over here. Okay, number one, this move down, it has little to no momentum or volume. I personally don't like the fact that there's no momentum and volume in this move, so I would not take this as an order block. Even if the market was in my key point of interest. Even if it was. So remember, if your order block does not produce strong momentum with imbalance and strong volume, that basically huge chunky candles like this, then you don't want to take it, right? You don't want to take it. Remember, you should be somewhat conservative, with the way you trade, because if you're too liberal, as in you're too open, not that I'm trying to get political, I just don't know any other words that I could use, but if you don't know, if you're constantly looking to literally trade everything, then you're gonna have a hard time trying to distinguish between falsehood and and truthfulness, as in not everything is truthful in this market, as in something to look one way but it's the other. Perfect example is when you see an order block but the market doesn't respect it, right? So what do we see? The first thing you want to do is come to the one conclusion. Okay, how much of a sniper entry do you want? Do you want such a sniper entry where it's a high RR trade, like 1 to 30, 1 to 50? Because I can tell you this, if we go to the 1 minute time frame, there possibly could have been some type of entry at the very, very bottom over here where the market was producing movement such like this, and not necessarily a break of structure was present, but momentum was present, and then the 30-second time frame kind of retraces back to the closest supply zone. And what's going to happen with that type of style is your stop loss is going to be extremely low, and your take profit will also be pretty, it won't be like high in pips, but because your stop loss is so small, your RR will be extremely large, and that's going to allow you to capitalize on such a long-term movement whilst you're only holding it for a short-term time. Meaning a long-term movement, meaning like it's a long-term move like this, but you're only holding it for a short-term amount of time, right? And the only difference is now that we're doing it on the 3 minute time frame. So the smaller the time frame you go on, the better the entry you're gonna get, but also there's a chance that you may miss out on the entire trade. But according to this 3 minute narrative, we can see that the market actually reaches to this point, and then from there it sells off, invalidating this point of supply with a decent momentum. Now, to be completely honest, for me this wouldn't have been sufficient. I probably wouldn't have taken this trade, but I know because of the style of how a lot of you do trade, this would have been sufficient. So that's why I'm just providing this example. But I would provide an example of what I would do, but sadly I can't go down to the 1 minute or even the 30-second time frame because of the trading view candle limit. But that's fine, it's not a big deal. Now, take profit wise, where would you target? Some people would just target the next low, other people would target over here. If you're a crazy guy like me, not that I would actually hold it up to here, but you could target this very low and try to go for the next low. And a big part of catching sniper entries is also about losing before you catch those entries. Remember, when your stop loss is so congested to something like this, so something about 4.5 pips, what will happen is you might get stopped out due to spread, or the market might do something like this, take you out and then reverse. And it might even happen here if we see. Okay, matter of fact, let me go to the 3 minute time frame again. Okay, looks like the market missed our entry by 1 pip. It was 1 pip shy, but let's see what ends up happening. And has it been taken out? Nope. Now it has clean. So notice how after, for me, remember, this was not a sufficient entry, so even if we did get triggered, I wouldn't have taken this in real time, to be completely frank. But if we see in real time, not in real time, but we see that now this low is broken, and what happened is this low was broken with momentum and volume, right? So I can now make my way to the higher time frames and look for a very clean entry, like a very clean supply zone right over here. And remember, sometimes supply zones aren't always mitigated when you want them to be mitigated. In this case, price action reaches that supply zone, and it slowly starts to sell off. Does it reverse back? Let's take a look. And okay, it slowly starts to sell off. So as you can see, this is a sniper entry right over here. The market literally mitigated that supply zone with little to no drawdown whatsoever, and it right away goes all the way down into profit. And then from there, of course, depending on how you would have managed that entry, this would either be a winner for you, it would either be a stop loss, or it would either be a break even or partial. Some of you might be wondering, okay, how do you actually catch this? It's very simple. The reason this was not a sufficient entry for me right over here, this 3 minute, is because although a small area of supply was invalidated, structure still remained to be bullish. And I do not like to trade against the structure, even the trend, even if the supply zone was broken or the demand zone was broken. So what I did is I waited for this low to break. As soon as I saw that low was broken, I found the supply zone, which was at the top of the original move, and that was right over here. So we can see that the market goes down, and then it trades back within this area of supply. And we mitigate it right away, and then the market starts going down, and then from there the rest is history. You can see what ends up happening. Let's play this out really quickly. And Does it hit TP? Yes, as you can see, take profit is hit. And matter of fact, within this entire move, there's even more entries. It's all about using the smaller time frame to your benefit. So we can see that there is another supply zone right over here, and the market reaches that point. Let's see how we could have incorporated the sniper entry model to actually catch a sniper entry. In this case, let's take a look if there are any opportunities. Yep, found one right over here. Look how beautiful this one is. So the market reaches. All right, so take a look at this. We can see that the overall trend is bullish. We can see that low. There's a high, higher low, and then there's a smaller lower low, lower high, and then a higher high. And then within this movement, we have a break of demand right over here. Now, I did say, I'm going to contradict myself a little bit. I did say that, look, in certain times, I did say that I don't like to take trades against the trend, even if demand was broken. I always like to trade with the trend in very rare circumstances. And I'm going to make a video on this later on, because if I go over this topic today, we're going to be here till a couple of hours, because it's a deep topic that I'm still somewhat, trying to get my mind to grasp it, to understand it. But in some situations, it's okay to take trades against the trend as long as supply and demand was broken. In some circumstances. In this case, I would consider it to be valid simply because of all the momentum that this move produced. And the fact that we were able to invalidate that move despite the momentum behind it proves that there's another greater entity with more momentum and volume. And in that case, that was this move, because this is the original move that made us invalidate this order block right here. So essentially what we would want to do now is we'd look for the entire, not the entire, but the origin. Once again, we'd look for the origin of the move, and we look for the supply zone. And in that case, it would be right over here with the stop loss at the very high. And take a look what session this was in. And this is also during London session, whilst Asia session was manipulated. So you could see the beauty behind these confirmations right here. I know what ends up happening next. Very, very simple. Let's just target the next low to see what happens. This is a perfect example. So as you can see, the market didn't actually invalidate the supply zone. As you can see, there's still some space. But what happens is, due to spread, even if you accounted for spread, there's a high probability that you may have been stopped out to this according to your brokers, policies, and etc. Sorry, not policies, but liquidity provider and all that good stuff. But yeah, you may have been stopped out, and that's a risk you have to take with sniper entries. Once again, there's positive, there's benefits. It's all about just taking the good with the bad and the bad with the good. I was trying to go to the smaller time frames to provide another example. But anyways, as you can see, the market reaches that point, and then from there we absolutely take off, hitting it 18-1. And it's very, very simple. Something I really want you all to notice is that most of these entries that I'm showing you, these hypotheticals and these hindsight entries, are normally at the top of the market. So behind the theology or the psychology of a sniper entry is you're trying to call the top of the market, and that could be extremely exhausting, especially because of the countless losses you take before you actually successfully call the top of the market. Once again, no one has no, I can't say no one, but the majority of the forex traders, us, the general, we don't have the resources and the tools to see where the banks are actually buying, unless you have order flow and you know how to use that. But even then, you're also still limited. So this is why you could lose a ton of times before you win, and that could get extremely exhausting. So but anyways, I don't want to get into that topic, because once again, that's another topic for another video. But yeah, I hope you guys enjoyed this video. I hope this video was informational and you learned how to actually incorporate this into your trading plan, how to actually catch sniper entries, and the in-depth understanding behind why sniper entries are good, but also why they could be exhausting and not the best decision according to your style. But with that being said, thank you all so much for watching this video, and until then, I'll see you next time. Traq out.